Hello, everyone, and my name's Chris Johnson. I'm a business lawyer, business owner, and also real estate investor. In fact, I've been investing in real estate in one form or another since I was about 20 years old. I initially got started working on small retail strip centers, which we did value adds and flipped after about 5 years and increasing the rent rolls. Then I took a hiatus for a while and I went into law and became a partner. Now I'm back in real estate, have a title company, and I work with a lot of real estate investors, like perhaps you. And I wanted to share some tips, tricks, and some of my experience, things that I've developed over the decades and from different groups and mentors that I've had. And I've spent a lot of money learning these things, and I made some mistakes on my own. And I wanted to share some of these tips with you. And this is about maximizing your returns in real estate. So this is this guy, Andrew Cordell, and I know him from one of the mastermind groups that I'm in. And he was up on stage and said something, and it really resonated with me. And it says, what games are you playing and who are you playing them with? So the point of what he talks about is that we have been programmed, we've been told to act in a certain way. One of those ways might be something like, make sure you set aside sufficient money in your 401k and invest it so when you're older, you can then retire because you'll have a nest egg in your 401k. Now, what are the problems with 401ks? 401ks have a limited set of investments that you can invest in, maybe S&P 500, things like that. And those are fine. I own them myself. But what I like is freedom and flexibility with my own money. And there are some strategies that you can use other than cash to have that. So one of those things is the Roth IRA. And first of all, I just want to go into the IRA. And many of you might be like, well, isn't that essentially the same thing as the 401k? Or I have an IRA, it's over at Schwab or one of the other big companies, and I can pick from all their different ETFs, stocks, bonds, CDs. Great. What Schwab doesn't let you pick is an investment property that you might want to purchase, or you might want to do a private equity deal, something that's not listed on the public exchange. For example, in my Roth IRA, I bought some SpaceX. The point being is that I hope that SpaceX has a really good multiple once it goes public. So I want that to be in my Roth IRA because that's post-tax and I will never be taxed on that money ever again. So this is one of the strategies used by Peter Thiel, who's like the godfather of this strategy, looked up to in the industry. And, I believe it was PayPal. He got some equity and he turned several $1,000s in his Roth IRA over time into billions of dollars, making really good investments and startup companies. There are limitations for how much you can actually put in a Roth IRA. A lot of people that I work with are already phased out. But there is this thing called a backdoor Roth, where every year you can take some money. It's about $6,000 before age 50 and about $7,000 after age 50. And you can take this, you can put it into an IRA and then immediately transfer it over to a Roth IRA. Because it's an immediate transfer and because it's only invested in cash, there's no tax consequences. You're not going to have to pay any taxes on it, and you put it in your Roth. It's not a whole lot, but at least it's something every year, some powder that you can put in the gun to invest in your Roth. So difference between an IRA, to back up a little bit, and a Roth IRA is the IRA is all pre-tax and the Roth is post-tax. I'm a big believer in the Roth, but either the IRA or the Roth IRA is fine. All I want to say is I like having options to invest in other things. I don't want to be stuck in the public market. Some of that's good, and I have a portfolio of that. But what I really like to build wealth are investing in real estate using a Roth IRA. So let me tell you one strategy really quick that a friend and client of mine does. And I'm not endorsing this real estate strategy, but I'm sharing it with you to see how amazing it could be in a Roth. So he believes in investing in small lots because they don't have tenants to worry about. There's no improvements to the property. There aren't high property taxes. Really, you don't have to do anything. You buy a lot and it just sits and you pay a little bit in property tax every year. He likes getting interior lots, really cheap ones. He doesn't buy on the lake or waterfront or corner, big lots, anything like that. But on the interior in communities that have those available, let's call it 10 grand. So he'll buy 10 grand lots using his $100,000 that he has in his Roth IRA. And then he just sits and he waits. And so there's a period of, let's say, a couple years, 5 years, the community starts getting built out. In the process, these lots are becoming more valuable. And let's say they double, 100% return in 5 years, which is a really pretty darn good return, and you didn't have to do anything. Now he'll put a sign up in the yard, 0% financing guaranteed. He'll go to the neighbors. If there's an adjoining a house that was built next to the lot, he'll go right there. He has a captive market. He doesn't have expenses for realtors or anything like that. And then he'll seller finance the lot. And his thinking is on a $20,000 lot, who's going to default on that? The payment is already so low. They're always going to be able to make that payment. So now what you've done in your Roth is you have taken a $10,000 investment, 100% increase. So now it's worth 100% more. And then you have seller finance within that same wrapper. And let's say you're getting a 10% rate on that. So now you've doubled your money and you're getting the 10% on the double your money, all within your Roth and not paying any taxes on it. And over time, using strategies like this, the Roth IRA can be really effective in building wealth. The next thing I'll talk about, one of my favorites, so much of my favorite that I actually started an insurance company that caters to our high net worth clientele and underwrites these policies. Because unfortunately, the way the commission structure is, insurance agents are disincentivized to design high upfront cash value policies as opposed to, at the end, a high death benefit policy. What we want to look at here for a concept called infinite banking is designing in high cash participating whole life policies. So that's a large portion of the premiums go to the cash value, and this is what we sell and we provide to our clients. And in essence, it acts as a supercharged savings account. The earnings in the policy are tax-free. The death benefit at the end is tax-free. You can bank yourself. What I mean by bank yourself is instead of me going to the loan, for example, for the pool that I just built, I could have gotten a loan at maybe 10% from some financing company. I just borrowed from myself in my cash value policy, and I used that money for my pool, and then I slowly paid myself back at an interest rate to myself. And the policy has to be structured correctly to do this, but even while the loan is outstanding, that amount of the cash benefit is still going towards your death benefit. So people like to triage these things. They'll like to borrow from themselves at 5% and then buy a rental property that's yielding 10%. Now they're triaging their own money and they're not even going to the bank. They're banking themselves. Another thing I love about this is asset protection. And this isn't like this everywhere in the United States. So you got to be careful. It's really on a state-by-state basis. But in Texas, at least, the cash value is protected from creditors and the death benefit is protected from creditors. Another interesting thing here is actually spending down your money in retirement. Why do I need millions and millions and millions of dollars out in my estate that is going to ultimately be taxed by the federal government when I die? Why not move it to things outside my estate? You can set up trusts that are funded by insurance. You can just set up insurance policies. People will buy massive policies and they'll start shifting some of their wealth into these policies so they can go under the estate exemption threshold. And then the death benefit is being passed tax-free to their heirs. God forbid when they're 80, 90 years old and they're like, wow, I misjudged and I don't have enough money to live on. One of the things I realized is you can borrow the cash value, and if you don't pay it back, it just comes off the top of the death benefit. And that's why I call it a supercharged savings account. The money is there, it's just supercharged. It's providing death benefit and it's providing asset protection. I really, really love this product, and it's great for real estate investors. I see a lot of home flippers out there that are using hard money lenders. And look, don't get me wrong, I love hard money lenders and I represent them myself. But I also see home flippers out there that are using infinite banking, and that's what I would do. It takes discipline, it takes building up a cash value over time, but eventually you're not going to banks anymore. You're not going to hard money lenders anymore. You're just going to yourself. You're borrowing from your policy, you're paying it back, and that's it. And you're able to skip the middleman and do what people that have created wealth over time have done, and that's getting into the banking system and banking themselves rather than going to a third party. Real estate depreciation is another reason that real estate investors love real estate. So the real estate depreciation, it acts as an expense or a loss, and it offsets passive income on the property. So if the property is getting $100,000 in rents and it's able to get $100,000 in depreciation expense, then zero taxes are owed on that property for that year. Now you got to be careful because there is depreciation recapture, and that is where the IRS requires you at the end to go ahead and account for that expense and add it back on almost as a capital gain to the property, and then you have to account for that somehow. Put a pin in that. I'll get to that next. Going back to depreciation, one way to offset active income is to have a spouse that's in real estate. Doctors like doing this, lawyers, other people, because they have a lot of active income and they want to buy locations for their practices and they want to take that depreciation expense. Unfortunately, they can only depreciate the rent. They can't then go ahead and depreciate active income, their active income. But if their spouse is in real estate, files a joint return, and manages these properties, now they can claim the real estate depreciation as a deduction on active income. It's a really, really great strategy. So going back to depreciation recapture, one way to get around this, or at least to defer it, to kick the can down the road, is for a 1031 or a like-kind exchange. And I've done an extensive presentation on 1031s. Just go ahead, look for that, and I'll get more into detail. But essentially, a 1031 allows you to defer capital gains and to defer that depreciation recapture. So defer it till what? Well, it would be deferring it until you die. And I'll address that next. But first, I want to show you this graph shows you how over time a 1031 exchange can really inure to your benefit, because instead of taking 2 steps forward and 1 step back every time you sell a property, you're taking 2 steps forward, 2 steps forward, 2 steps forward. And all those 1 steps back, we're just going to put them off to the side and we'll deal with them later. But it shows the compounding effect of money and not having to deal with taxes. And that's the green line on this chart. You can see it even the curve gets steeper and steeper every year because there's an added benefit every year that taxes aren't going to have to get paid. The blue line is where taxes are going to get paid. And you can see we're in that final year, and these are just assumptions, but in the final year, at year 25, there's a pretty big gap between that green line and that blue line. Shows the benefits of a 1031. So I said that you have to pay the piper eventually. The depreciation and the capital gains can only be deferred until a certain point, and that would be at the point of death. So what happens at death? We have to look at the estate exemption threshold. It's currently $12 million for a single person, $20 million for a married couple filing jointly. So it's quite substantial, but this is set to expire in 2026. It's going to go down to a lower amount. And then it's really just up to whatever administration's in place and whether they're, for this exemption being high or for it being low. As long as all the capital gains and the recapture and all those things at the end of the day are under that estate exemption threshold, then you don't have to pay estate taxes on it. To the extent that they're above the threshold, then you would have to pay estate taxes, which would be 40%. Even if you have to pay estate taxes on these capital gains and the depreciation expense that you've deferred, it's still better to defer paying taxes until a later date, as I showed you in that previous graph. I refer my clients to IPX 1031 as the intermediary for exchanges. I have no ownership in that company, but it is a subsidiary of Fidelity National Title, who I am proud to exclusively underwrite with. IPX 1031 does a great job, and it's a simpler process than you might think using a 1031. You don't necessarily need to use an accountant or a lawyer. In fact, IPX 1031 is probably better than a lot of accountants and lawyers because they do this stuff on day in, day out basis. If you need to get a hold of them, you can go to this website, or you can feel free to reach out to me and I can connect you with my contact. You can reach out to me using that QR code. You can also send me an email to chris@fidelitylakehhouston.com. I love working with real estate investors, helping real estate investors, and I'm always willing to talk and help them. Thanks.